Welcome to today's video, how to not run out of money during retirement. When we are in our retirement years, we for sure don't want to be stressing about running out of money. So in today's video, I'm going over exactly how to not run out of money. Let's dive right in. All right, the first thing that we want to do so that we don't run out of money in retirement is to start saving and investing our money as early as possible. The earlier we start investing our money, then the more time it has to grow, the more we can take advantage of compound interest. And I know a lot of people out there say that you should be saving or investing 10% of your income, but honestly, I would say invest as much of your income as possible, because the earlier we do that, then the less money we actually have to put in, and the more it builds because of compound interest. And to give you an example of exactly what I am talking about, let's say you started with $10,000 and then you decided to invest $1,000 every single month, and you did that over a period of 10 years at a 10% rate of return. At the end of those 10 years, you would have $231,915. But if you were to do that over a period of 30 years, you would have a total of $2,458,862. You can see a drastic difference if you're giving yourself more time to invest. And then the second thing we can do to help us not run out of money in retirement is to set up a retirement plan, actually know what we are working toward. We want to figure out what our expenses will be in retirement, at least come as close as possible, and then we can figure out exactly how much we will need to have invested in order to retire and not run out of money. And let's dive into this a little bit deeper. I want to show you the numbers so that you can really figure this out for yourself. I personally like using what is called the 4% rule. A lot of people in the FIRE community, Financial Independence Retire Early community, use this rule. And essentially, if you take your annual expenses in retirement, multiply that number by 25, that is the amount that you want to have invested, not just sitting in a savings account. For example, if your annual expenses are going to be $40,000, you'll multiply that by the number 25, and that would be $1 million. So you would want to have $1 million invested, and then you could start withdrawing your money and have a really good chance you are not going to run out of money in retirement. And the cool thing about this is that it is adjusted for inflation. And this is based on the Trinity study. And I want to show you this website. It's called thepourswiss.com. You can check it out later on. But they have gone over the numbers for the Trinity study, and they have taken it all the way to 2022. They're looking at the return on stocks and bonds throughout history. So I've gone to their website and I just want to show you one of their charts. So let's take a look at this. If you have 100% invested in bonds, it is going to be the blue line on the chart. And then if you have 25% in stocks and the rest in bonds, then it's going to be that darker red color. And then 50% in stocks and 50% in bonds, it's going to be the yellow. And then 75% in stocks and 25% in bonds, it's going to be the green color. And then 100% in stocks is that orange color. So if we take a look at the graph, you can see at the bottom the withdrawal rate. So if we are using that 4% rule, that means we are withdrawing 4% of our money every single year. You can see on the chart, if you are fully invested in bonds, 100% in bonds, that blue color, then you have just under a 50% chance of running out of money during retirement. But if we take a look at that orange line, which is all the way at the top, that's 100% invested in stocks, and you're withdrawing 4%, you have about a 98% chance of not running out of money during your retirement years. So we can see if we have 50 years in retirement and we are still invested 100% in stocks, we have a pretty high percentage of still not running out of money at the 4% withdrawal rate. And of course, if we move that to 3.5%, then we have more than a 98% success rate. So of course, we don't know what the future is going to hold, but this gives us a pretty good place to start. And of course, if we have all of our money invested in stocks, that is very risky. So if we are looking to retire sooner than later, we may want to move some of that money over to bonds to help preserve our wealth, because if we do retire in a year that is down and we start withdrawing our money and keep withdrawing and the stock market continues to go down, our success rate will drop. But here's the thing, I feel comfortable using a 4% withdrawal rate. I've seen the success rates and I feel good about that, but I also know that if I don't want to run out of money during retirement, that I need to be flexible, and I feel like this is really key. During our retirement years, if we have a trip to Israel planned and the stock market tanks that year, then I know I can be flexible and postpone that trip for another year. Or I could even get a part-time job and start supplementing my income. There are just things that we can do in retirement to help us make sure that we don't run out of money. But of course, we want to set up our plan as well as possible. So we want to feel comfortable with the numbers that we are using. And we also want to have a really good estimate on what our expenses are going to be during retirement years. And I know that can be difficult to figure out. And a lot of people will say that you can take about 70 to 80% of your current expenses, and that's what your expenses will be in your retirement years. And of course, if you are in your early 20s, your expenses are most likely very, very low. So that formula won't really work. You need to figure out, okay, does this seem logical? Where my expenses are right now, do I think that's going to be a little bit lower because maybe I won't have a mortgage payment or I won't have a car payment, but my healthcare expenses may go up. So try to pick a number as close as possible, and then you can make adjustments along the way. And going back to that being flexible part, if we really need to reduce our expenses a lot, then an option could be to downsize. We could move to a smaller home. And if our current home is already paid off, then by moving to a smaller home, we can probably sell that current home, have some extra income that way, and we can invest that extra income so that we are adding to our portfolio. And if you want help figuring this all out and learning to invest your money in the stock market in the best way possible for you, I have a free masterclass where I go over how I can help you invest in the stock market and also help you understand how to not run out of money during retirement. I will leave a link to my free masterclass below in the description, and you can check that out and get some help from me. And comment below and tell me if you already know how you are going to not run out of money in retirement years. If you found this video helpful, please hit that like button and share it with someone else who would like to hear this information, and hit the subscribe button to subscribe to my YouTube channel and hit the little bell to get notified on when I post new videos. And if you want to see even more awesome content from me, make sure and check out the videos on the side of the screen. Thanks so much for watching. I'll see you in the next video.